This 900-page bill could change your retirement forever, but no one's talking about what's really inside. While politicians argue about headlines, there are real changes happening that could put thousands of dollars back in your pocket or create new barriers to the benefits you've earned. I'm talking about tax breaks worth up to $12,000 for married couples, prescription drug caps that could save you thousands more, and yes, the truth about what's really happening with Social Security taxes. But there's also some fine print that could make accessing your benefits harder than ever. I spent hours reading through this legislation so you don't have to. Let's break it down, clear and honest, one step at a time, because these changes only help if people know about them. Let's start with the good news. If you're 65 or older, there's a brand new $6,000 tax deduction waiting for you. This isn't replacing anything you already get. It's on top of your standard deduction. Here's how it works. Right now, if you're single and 65 or older, you get a standard deduction of about $15,700. With this new law, you'd get an additional $6,000, bringing your total to $21,700. If you're married and both spouses are 65 or older, you each get the $6,000. That's $12,000 total on top of your standard deduction. But there's a catch. This isn't available to everyone. If you're single and your income is over $75,000, or if you're married and your combined income is over $150,000, this deduction starts to phase out. It doesn't disappear immediately. It reduces gradually as your income goes up. The important thing to understand is that this reduces your taxable income, not your adjusted gross income. That means it won't affect things like Medicare premiums or Social Security taxation calculations, but it will reduce the amount of income you pay taxes on, which puts real money back in your pocket. There's one more thing you need to know. This deduction expires after 2028. Unless Congress renews it, this benefit goes away. So if you qualify, make sure you're taking advantage of it while it's available. The best part, if you're eligible, it's automatic. You don't have to apply for it or jump through hoops, but it's still worth double-checking your tax situation to make sure you're getting the full benefit. Now let's talk about Social Security taxes, because there's a lot of confusion out there. I've seen headlines claiming this bill eliminates taxes on Social Security benefits. That's not true. The federal government can still tax your Social Security benefits, and this bill doesn't change that. The IRS formula for determining how much of your benefits are taxable, called provisional income, stays exactly the same. Here's how it actually works. The IRS adds up your adjusted gross income, plus any tax-free interest you earn, plus half of your Social Security benefits. If the total is over $25,000 for singles or $30,000 for couples, some of your Social Security gets taxed. What might help is that new $6,000 deduction we just talked about. Since it reduces your taxable income, it might lower the amount of tax you pay overall, but it doesn't change whether your Social Security benefits are taxable in the first place. And here's something many people don't realize. Even if the federal government doesn't tax your Social Security, your state might. 13 states currently tax Social Security benefits, and this federal law doesn't change that. You earned your Social Security. You paid into it for decades. But yes, it can still be taxed. This bill helps a little bit, but it doesn't fix the core issue. Here's where things get really interesting for anyone dealing with expensive medications. Starting in 2026, there's a hard cap on what you pay for prescription drugs under Medicare Part D to $000 per year, no matter what. This is huge. Right now, if you need expensive cancer drugs, insulin, or specialty medications, you could be paying thousands or even tens of thousands of dollars out of pocket. With this cap, no matter how expensive your medications are, you won't pay more than $2,000 per year. But here's the smart part. You don't have to pay the $2,000 all at once. The new law includes a monthly payment option. So instead of getting hit with a massive bill when you pick up an expensive prescription, you can spread those costs over the year. There's more good news. Medicare is also expanding its power to negotiate drug prices directly with pharmaceutical companies. This means the actual cost of medications should start coming down, not just what you pay out of pocket. Let me give you a real-world example. Say you need a cancer medication that costs $8,000 per month. Under the old system, you could be looking at thousands of dollars in out-of-pocket costs. With the new cap, you pay no more than $2,000 for the entire year, and you can spread that over monthly payments. This is predictable drug costs for people on fixed incomes. No more choosing between medications and groceries. No more rationing pills to make them last longer. No more than $2,000 per year on medications, no matter what. Now we need to talk about some changes that might not be as helpful, especially if you're worried about long-term care costs. Medicaid pays for most long-term care. In America, about 60% of nursing home residents rely on it, so changes to Medicaid rules matter. The bill tightens eligibility rules around home equity. Right now, if you own a home worth less than a certain amount, you can still qualify for Medicaid. The new rules make this more restrictive, which could affect your ability to get help with nursing home costs while keeping your family home. There are also more frequent eligibility redeterminations. This means Medicaid will check more often to see if you still qualify for benefits. While this is designed to prevent fraud, it also creates more paperwork and more chances for people to accidentally lose coverage due to bureaucratic mix-ups. The bill also changes how states fund their Medicaid programs through provider taxes. This could reduce the money available for Medicaid services, which might mean longer wait times for care or fewer providers accepting Medicaid patients. And some of the expanded home care services that were added during VID are being phased out. This could make it harder to get the help you need to stay in your own home instead of moving to a nursing facility. The bottom line, if you're planning for long-term care, these changes could make Medicaid eligibility more complicated and potentially more restrictive. Here's something that could create real problems for a lot of seniors: new identity verification requirements for accessing Medicare and Social Security online. The goal is to reduce fraud, which is admirable, but the execution could leave many seniors locked out of their own benefits. Starting soon, you'll need to verify your identity using biometric scans, document uploads, and multi-factor authentication. This means fingerprints, face scans, uploading photos of your driver's license, and getting text messages or emails with security codes. If you're comfortable with technology, this might not be a big deal, but if you're not tech-savvy, live in a rural area with poor internet, or have disabilities that make using these systems difficult, this could be a real barrier. Think about it. To access information about your Social Security benefits or Medicare coverage, you might need a smartphone, a reliable internet connection, the ability to take clear photos of documents, and the knowledge to navigate complex online systems. My advice: don't wait until these systems are mandatory. Set up your accounts now at Medicare, Gov, and SSA. Gov, get familiar with it, which is the system many government agencies use for identity verification. And if you need help, ask a trusted family member or friend to walk you through the process. The trade-off between security and accessibility is real. These systems will definitely reduce fraud, but they could also make it harder for legitimate beneficiaries to access their own benefits. Here's some good news if you're still working and trying to catch up on retirement savings. The Savers Credit, which gives you a tax credit for contributing to retirement accounts, is getting expanded. The maximum credit is increasing from $0.000 to $100 in 2027. This credit goes to low and middle income workers who contribute to IRAs, 401ks, and even able accounts for people with disabilities. What makes this credit special is that it's not just a deduction, it's a credit. That means it reduces your tax bill dollar for dollar. If you owe $1,000 in taxes and you get a $500 credit, you only owe $500. This is especially helpful for people who are working part-time in their 60s and 70s, or who had to take time off from saving for retirement and are now trying to catch up. Still working in your 60s, this credit is designed for you. The eligibility is based on your income and is designed to help people who aren't high earners but are still trying to save for retirement. Every little bit helps when you're playing catch-up. Now we need to talk about something that could quietly undermine everything we've just discussed: the PAYGO rule. PAYGO stands for Pay As You Go, and it's a budget rule that says if Congress passes a law that increases the deficit, automatic spending cuts have to happen to offset it. Here's the problem: this bill, with all its tax breaks and spending increases, could trigger those automatic cuts. And where do those cuts typically fall? Medicare provider payments. This doesn't mean your Medicare benefits get cut directly, but if the payments to doctors, hospitals, and other providers get reduced, they might stop accepting Medicare patients or reduce services. The end result is the same harder access to care. Congress can waive the PAYGO rule, but they haven't done it yet for this bill. So right now, there's a real risk that the very programs this bill is supposed to help could face cuts on the back end. It's not a cut yet, but it could be, and it's the kind of inside the Beltway budget rule that most people never hear about until it's too late. Social Security isn't directly affected by PAYGO, but it could face pressure later if deficit concerns continue to grow. So what does all this mean for you? This bill won't fix everything, but it shifts the math in your favor if you know where to look. The tax break puts more cash in your pocket. The drug cap provides real relief for people on fixed incomes dealing with expensive medications. Social Security is still taxed, but the overall burden might be eased a bit. And yes, there are some red tape issues with Medicaid and new requirements to watch out for. Here's what you can do right now. First, check your eligibility for the new tax deductions. If you're 65 or older and your income is under the thresholds, you could be looking at significant tax savings. File your taxes carefully and watch those income thresholds. Second, get online ready now for the new requirements. Don't wait until you're locked out of your accounts. Set up your Medicare, Gov, and SSA, Gov accounts while you can still get help. Third, stay informed about PAYGO developments. If you're concerned about potential cuts to Medicare, contact your representatives. Your voice matters. And finally, help others understand these changes. Share this information with friends, family, and neighbors. These changes only help if people know about them. The bottom line, stay informed, double-check your eligibility, and help others do the same. Your retirement security depends on it.